Good morning, good afternoon, good evening, and good night, ladies and gentlemen, from wherever you are watching from. You are once again welcome to my channel. So, not to waste much of your time, let's get straight to the main content of today's video. In today's video, we are going to be looking at market structure. Market structure is very important in price action. So if you know how the market moves, you'll be able to know when to enter and when to exit and when to stay away from the market. That is why market structure is very important in forex trading. So that is what you are going to learn in today's video. Remember that I said that what I'll be teaching you is pure price action so that you can benefit from the market. For you to understand price action very well, you need to understand market structure. And that is what we are going to look into in today's video. Now, when you look at the chart, you see that the market is in a downtrend, right? Now, if you want to understand market structure, what you need to understand is the movement of the market, because market moves in a cycle. It rotates. It can be in an uptrend, it can be in a downtrend, it can be in a range. So you need to understand the market structure very well so that you can be able to profit from the market. Now, looking at the chart here, you can see that the market is clearly in a downtrend. So that is what you need to understand in this market. So market structure is very, very important in forex trading. Because why is market structure so important? Now, if you want to trade and you enter the market, the first question you need to ask is, what is the market doing? That is market structure. Market structure will help you to know whether if the market is trending up or trending down or ranging. Then you now know the type of strategy that you are going to use in that market. Because you don't use all strategies in all the markets. You remember what I'm saying? There are strategies meant for a trending market and there are strategies meant for ranging market. But the market structure will help you to know the type of a strategy that you implement in your trade. In my previous video, I talked about Fibonacci retracement, and I told you that you can only use the Fibonacci retracement during a trending market. So it is now left for you to understand when a trending market is and when the market is ranging, so that don't go use the Fibonacci retracement on a ranging market. So now, if you truly want to understand how the market structure works, I'm going to give you a simple steps on how to do that. Okay, so what we are going to be looking at in today's market is market structure. It's very important that you understand how the market works. Because if you know how the market works, you will know when to enter and when to exit your trade. So market structure simply helps you to know how the market moves, to know whether if the market is up or down or just ranging. Then you now know when to trade, whether to enter, to exit, or to stay away from the market. So now we are going to look at the 4 stages of the market. There are 4 stages in the market. So this is what we are going to look at. The 4 stages of the market, how the market moves. So that is what we are going to look at right now. So now there are 4 stages in a market, 4 stages that make up a market structure. We have the accumulation stage, we have the advancing stage, we have the distribution stage, and we also have the decline stage. So we are going to look into this market structure one after the other. First, the accumulation stage is a ranging market in a downtrend. A ranging market in a downtrend. I'm going to show you is a picture example of it so that you understand what I'm talking about. All right, look at the market structure here. You can see the accumulation stage where the market is making a range in a downtrend. First, there was a strong downtrend, and after that, the market started to consolidate. You can see how the market is consolidating, and that consolidation is what is referred to as the accumulation stage. In other words, you can call it a ranging market in a downtrend. So whenever you spot a ranging market in a downtrend, you cannot call it an accumulation stage, because the market is ranging in a downtrend. Then after that, we have the second one, which is known as the advancing stage. After the market finish ranging, what does the market makes? It breaks out and starts to rally up. That is when the advanced stage comes in. Remember that during the accumulation stage, when the market is ranging in a downtrend, both the buyers and the sellers are in equilibrium. The buyers and the sellers are exchanging market. Why is this? When the market gets to the resistance level, the sellers will hit. When the market comes to the support level, the buyers will hit. And this is how they will be exchanging price until either one of them push the market either higher or lower. But if the market breaks the resistance and start heading higher, we now enter into the second stage of the market, which is known as the advancing stage. The advancing stage is a market where the price is making higher high and higher low. When the price is making higher high and higher low, we know that we are in an advancing stage. That is to say, the market is in an uptrend. So I'm going to show you a picture of an advancing stage for you to understand what I'm talking about. So this is what we mean by the advancing stage. You can see the market was formerly in accumulation stage, making a range in a downtrend. So later on, the market now broke out of the range and started to rally up, which means that the market has entered into the advancing stage. So you can see the market is making higher high and higher low. You can see it higher high, higher low, higher high, higher low, higher high, higher low. So how do you trade this market? You simply trade only in the direction of the trend. Remember, in the accumulation stage, both the buyers and the sellers are in equilibrium. That is to say, the sellers wait for the market to come to the resistance level and they place their sell trade, while the buyers wait for the market to approach the support level and they place their buy trade. But once the market breaks out of this accumulation stage and start making an advanced stage, you are expected to only go up. Don't ever go down. You are expected to trade in the direction of the trend. So your focus should be buy. Don't think about selling, because if you check clearly, you can see that the direction of the market is up. So where do you place your sell? You wait for the price to make a pullback. You understand? Let the price make a pullback for you to place your trade. Most of traders all over the world make use of the moving average. Like me, I also make use of the moving average, like the EMA. So once the market breaks out of the accumulation stage, what you do is you plot out your 20 EMA and then watch the price action. Whenever the price retraces back to the 20 EMA, you place your trade. Like if you check, you see that this red line is the 20 EMA, while the blue line is the 50 EMA. So whenever the price comes to the 20 EMA and test it, the price tends to move up again. So once you enter the advancing stage, which is the uptrend, you are only meant to trade in the direction of the trend. So after that, the market will also make a range in the uptrend, because a market cannot go up forever. Sometimes the market will go up and then just break down. So when the market starts ranging after a long uptrend and the market start ranging in that uptrend, we enter the next stage, which is the distribution stage. Now the distribution stage is the place where the market is making a range at the uptrend. Where there is a range at the uptrend, you know that we are in the distribution stage. Like I said, during the distribution stage, the buyers and the sellers are in equilibrium. The buyers buy from support while the sellers sell from resistance. So both the buyers and the sellers are in equilibrium. They are exchanging prices. So that is how it will be going until the sellers push the price down and breaks the support level. We now enter into the next stage. So let me give you an example of the distribution stage so that you see it visually and understand what I am talking about. Now this is what we mean by the distribution stage. You can see it, a range at the uptrend. You can see the rally up, you can see how the market is rallying up, and after going up, the market tends to make a range at the up. You can see the range. So when you notice this type of market, you know that the market is clearly in a distribution stage where the buyers and the sellers are in equilibrium. Now what you do is you plot out your horizontal line, plot out your horizontal line and then map out the highs and the low. So this is the low, this is the highs. So what you do, you map out your horizontal line, and whenever the price touches the resistance, you place your sell trade, and whenever the price touches the support, you place your buy trade. So this is how buyers and sellers exchange price during the distribution stage. And like I told you, the distribution stage will not last forever. With time, either the buyers or the sellers will become more stronger, and the price will make another move. So if, let's say, the sellers become more stronger in the market and we're able to push the price down to the extent of the price breaking the support level, we now enter into the last stage of the market, which is known as the decline stage. So the decline stage is a downtrend. When the market is in a downtrend, we know that we are in a decline stage. So after the distribution stage, the market now goes into the decline stage. That is a downtrend. So after the range, the market will break the support level and start to rally down, meaning that we are in a downtrend. So when we're in a downtrend, please don't buy, only sell. We only sell during a downtrend. We don't buy, because if you buy, your stop loss will be hit so many times. Why? Because the market is clearly in a downtrend. That is why it's meant for you to understand the market structure very well before executing your trade. So if the market is in a downtrend, you only look to sell. And when do you sell? You wait for the market to make a retracement to resistance before you place your sell trade. So I'm going to give you a picture example of a decline stage, so for you to understand what we are talking about. So this is a picture of a decline stage. You can see the market now breaks and started to rally down. Look at it, how the market is going down. You can see it making lower high and lower low. Lower high, lower low, lower high, lower low. So that means the market is clearly in a downtrend. So what you do is this: you plot out your 20 EMA alongside with your 50 EMA and wait for price to make a retracement to the 20 EMA before you take your trade. Or you can use the trend line. If you don't want to use the 20 and the 50 EMA, you can also use the trend line and map out the highs in a downtrend. Map out the highs in the downtrend and wait for price to retrace back to the resistance level, which is the trend line. Then you cannot place your trade. So that is why I say whenever the market is in a decline stage, which is in a downtrend, you are expected to only place sell trade alone. Don't place buy trade, because your stop loss will get hit. That is why it's very important for you to trade only in the direction of the trend. So this is how the market structure works. That is why it's very important that you understand how this market structure works. So what I'm going to do now, I'm going to move into the main market and then show you an example of what we are talking about. Okay, now let me just all right, so this is an example of what I'm talking about, right? This example. Now let me just show you a clear example for you to understand what I'm talking about. All right, can see now the market is ranging here, right? Formerly the market was in a downtrend. The market was in a downtrend. You can see it now, and then broke this and went down. So the market, when the market got here, it now started to range. You can see the range. So this is what I mean by the first stage of the market, when the market is ranging in a downtrend. You can see it. So this is what we mean by the accumulation stage, when the market is ranging in a downtrend. So after that, the market now breaks out and start to rally up. This is another example of an accumulation stage. You can see the market is ranging here. This is another example of an accumulation stage. You can see it. So this is another example. So ladies and gentlemen, that is all I have for you on today's video. So that is how the market structure works. We have the trending market and we have the ranging market. There's time when the market is trending up, and there's time when the market is trending down, and there's also time when the market is ranging. So it is very important that you understand the market structure. Know when the market is going up, know when the market is ranging, and know when the market is going down, so that you don't place a sell trade when the market is an uptrend, or place a buy trade when the market is in a downtrend, so that you don't get hit many times. So ladies and gentlemen, I believe you have learned one or two from this video. Don't forget to subscribe to my channel for more content like this, and also don't forget to turn on the notification icon to be the first to be notified whenever I upload new content. Also, don't forget to share this video on your social media handle. Share with your friends so that they will learn more about forex trading. Thank you very much. See you in my next update.